Hey guys, welcome back to the channel. Today's video, we're going to be talking about the winners and losers from the Fed's fund rate. So overall, guys, we are now at a 5% Fed's fund rate. That is right, it is at 5%. So according to CME Fed Watch tool, it seems like this might be about the top. This might be the top of the mountain. This might be where they actually land. Could go up to 5.25, but 5%, 5.25 is kind of where they are looking to hold the interest rates. Now, over the past couple months, we have seen inflation slowly coming down. We've seen CPI slowly coming down. So it is working as intended, guys. As much as you watch the news and it's the end of the world and we're in a recession and everything's going to crash and the dollars are worthless, it's not really the case, guys. When you look, this is not the first time that we've seen this happen. This is not the first time we've seen inflation and recession and everything else in the United States. And this is definitely not the last time. Now, overall, guys, there has been some winners and some losers, and I want to kind of talk about that because that is where fundamentally, depending on where you kind of are in life, it makes a big difference. So number one, guys, looking at savings accounts and CDs. I've been in the banking industry for 16 years, going on 17 years now. I've seen savings accounts and CDs pay almost nothing. Money market accounts paid nothing. CDs paid almost nothing. It really penalized the saving aspect of people. So if you were a saver, if you were someone who was really diligent, that had a savings account, there was no interest rates really anywhere. That was the point where a lot of people put money into cryptocurrency. We've seen a lot of investments into the stock market because banks, financial institutions, credit unions were not paying anything. So with that being said, guys, I see a lot of members right now that are actually locking in CDs for a longer term, just because they know, again, we're kind of at the point where it is going to plateau. So taking things for a little bit of a longer term at a higher rate, locking in rates. I mean, if you look in the market right now, there are CD rates out there that are running 5% plus, which is a pretty good return. When you figure the S&P 500 yields roughly 8 to 10% a year, but that is very volatile. So if you're looking at a guaranteed return, you can find something that is about 5%. Shop around to get the best rates. Large banks have even started to increase the payouts for those deposits. And again, it is really time where if you're a saver, if you're looking to maximize your money, now is the time to lock in those rates. Now, on the flip side, mortgages, if you refi 21, 22, you got a sweet rate. You probably got 2.5%, 3.5%, possibly even 4%. Now, the problem that we're seeing right now, and of course, that is a good pro for where the Fed has kept rates for an incredible amount of time. A lot of people even got rates in that, again, that 2% kind of place. Now mortgage rates are about 6.5%. With inflation at 6%, really not coming down. They're usually pretty well priced in, even though the Fed's fund rate does not directly impact the mortgage rates. They're really dependent on the 10-year bond on what determines the mortgage rate. So when there is a possibility of the Fed's fund rate increases, usually long before that, you will see the mortgage rates increase. Now, because of this, again, if you had already gotten a mortgage, if you did anything of that nature, if you locked in your rates, great. Fast forward to today, mortgage rates again are pretty high. If you have a home equity line of credits, if you have interest only, you'll notice that the interest rate was 4%, 5%, 6%, 7%. Now some of them are 8%, 9%, 10%. We have literally seen the home equity lines of credit and the HELOCs that are variable rates. Now, this is also a huge impact when it comes to credit cards, guys. And that is one of the big things that I focus on in this channel is the elimination of debt. Really, the more knowledge, the more that you can take accountability for it to eliminate that debt, because as it gets more expensive, guys, and as these rates continue to rise, again, it gets more expensive. Third one we look at is stocks and bonds. Now, again, looking at CDs, if you know anything, 2022 for the S&P 500, a majority of the stock market really got crushed. With that being said, now is the time, guys, if you're looking to, again, short-term CDs, even looking at treasuries, but the stock market is at a deep discount right now. We've seen a little bit of a rebound into 2023, but overall, the stock market is at a pretty good reduced rate because of how tough the 2022 time was. Coming into 23, 24, 25, I think the stock market overall, especially if the Fed, when they get to the point of start lowering rates, the stock market now is kind of, in my opinion, the accumulation phase. I'm not a financial advisor, but this is the time that I'm really stocking up on a bunch of ETFs, which again, I absolutely love. And then when the Fed starts lowering rates again, you're going to see the stock market really, really shine. Now, the Fed's message to investors is the beatings will continue until inflation improves. It is a pretty funny way to think of it. Higher rates and reduced earning estimates mean additional volatility in the stock market and the bond market. But again, it seems like right now is a very, very poised, ideal time to buy. And I like spreading out that risk with those ETFs. The next one we look at is the borrowers. Now, again, this is where you're kind of getting into the credit crunch. If you're looking to get a personal loan, the national average is 11%. That is right, guys. These loans back even a year or two ago used to run about 6%, 7%. Now it is already up to 11. Student loans, personal loans, even if you're looking for auto loans, if you're looking for boats, power sports, anything of that nature, guys, plan to pay about double the rate that you seen last year, which again is based on the Fed's fund rate. And as that continues to increase, the rest of it will increase. The Fed's fund rate was near zero for an incredible amount of time. In my opinion, it was near zero for way too long, which is the reason why we're in this. Now, I know they held the rates very low because of COVID, the uncertainty, not knowing what was going on. But in turn, through the stimulus packages, they provided an incredible amount of borrowing power or buying power to, the citizens, to everyone who got a stimulus package that gave them kind of supercharged the buying power, which drove demand through the roof, drove inflation through the roof, so on and so forth. Now, the next one we look at is the U.S. government. National debt is nearing $32 trillion. Rising rates will raise the cost of the federal government and the debt that it needs to borrow. So if we're doing or getting new money, the government can benefit from decades of really low interest rates. But this interest that is on 32 trillion, you think buying a $30,000 car, buying even a $300,000 house, even $1 million house, $5 million house is going to compare to the interest that is running, the tally that is running on $32 trillion is just absolute asinine in the amount that the federal government has borrowed, and they continue to borrow. Again, when we raise money for the stimulus packages, things of that nature, we sold bonds. A lot of bonds brought in money to give to us, which again is kind of crazy. So really, guys, in conclusion, inflation has been running hot over the last couple years. The Fed is very aggressively looking to combat that. Take advantage, plan, like I said, eliminate debt. Now is really the huge time, guys, to eliminate a lot of the debt that you have. Cut the costs where you can, shop for things that you can actually find cheaper. And again, if you bought something probably in the last, I would say 3 years, chances are now it is going to be much more expensive to refinance, to look at really easing up the budget, which is the reason why you really need to buckle down, get rid of the credit card debt so you can start saving that money in an emergency fund. All right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.